What are you telling clients or doing for your clients right now, given the fundamentals so far look very good, right? But this risk of this trade war is overhanging everything.
Well, I think you're right. Fundamentals are still solid. Earnings are actually still quite strong. But of course, the sentiments are not that strong, especially in Asia. So given the trade risk is still there. And of course, there are some signs that liquidity conditions are starting to tighten, especially in Asia. So we're telling clients, watch out, the opportunities are coming, but still too early to become very bullish on risk assets.
Okay, keep your ammo dry is one thing, right? Yes. Keep your powder dry is one thing. But meantime, tactically, a lot of people are saying, look, what you really want now is you want uncorrelated returns, right? Which to me suggests alternative investments. It says hedge funds to me.
Yes. We are actually overweight hedge funds, but that's been structurally for quite some time now, and precisely for this sort of situation.
What strategies, though?
Well, we go for equity long short, even managers who have shown track record to be nimble in the midst of all these swings in markets. So I think you really want to be very nimble at this point of time, looking at alternative assets, even in private equity with a longer term focus, take the distraction out of the trade war.
Wow. James, how do we approach mainland Chinese equities, given the backdrop of deleveraging, trade tensions as well, and slower growth in the second half of the year?
Well, I think our message is to stay invested in China. There could be potentially much more volatility, at least in the near term, before the recovery sets in. A lot of watch would be on what the policymakers would do, but I think so far, I think still wait and see on that aspect.
Wait and see your opportunity, because, you know, rising defaults, a lot of people take a look at those in China and go, look, this is perfect. This is exactly what we want to see as a result of deleveraging. This is exactly what should happen, which means the last man standing, okay, yielding 8%, a corporate Chinese high yield, pretty much safer bets now.
Well, I think you still have to be very selective at this point of time. The risks are really there, especially you don't want to deleverage at a time where global sentiments are actually so weak. So I think investors have to be careful in China at this point of time. But nevertheless, I think valuations actually are looking very attractive, but possibly it could become even more attractive in the weeks to come.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.